31 words. That's all it took. 31 words buried in a Federal Reserve statement that most investors scrolled right past. Most financial media ignored it. Most analysts missed the significance entirely. But those 31 words just changed the gold and silver game in ways that few people have recognized yet. And if you hold precious metals, if you're considering buying precious metals, or if you're trying to understand why gold and silver have been acting strangely lately, what I'm about to show you is essential. Because the Federal Reserve just signaled something they haven't signaled in over 15 years. A shift in their framework. A change in their priorities. A pivot in their language that historically has preceded some of the largest moves in precious metals history. This isn't interpretation. This isn't reading between the lines. This is documented Fed communication, compared against their historical statements, analyzed through the lens of what similar language changes have meant for gold and silver in the past. The pattern is clear. When the Fed shifts language in this specific way, precious metals respond. Not immediately, not obviously, but predictably, once you understand what to look for. By the end of this video, you'll understand exactly what the Fed just communicated, why it matters more than most realize, how similar shifts have impacted gold and silver historically, and what it likely means for the precious metals market over the coming months and years. Because the Fed doesn't speak plainly, they speak in code, and that code was just updated. Welcome to the silent economy. Let's decode what just happened. Before I show you what the Fed just signaled, you need to understand how Federal Reserve communication actually works. Because if you don't understand the system, you can't interpret the signals. The Federal Reserve communicates through carefully crafted statements. Every word is deliberate. Every phrase is debated. Every change from previous statements is intentional. Fed watchers have developed an entire discipline around analyzing these communications. They compare current statements word by word against previous statements. They note additions. They note deletions. They note subtle changes in emphasis. This isn't paranoia. It's how the system works. The Fed tells you what they're going to do before they do it. But they tell you in code. Here's the framework you need to understand. There are 4 categories of Fed language shifts that historically have impacted precious metals. Category 1. Inflation language. How the Fed describes inflation signals their concern level. Words like transitory signal low concern. Words like persistent or elevated signal higher concern. Changes in how they characterize inflation often precede policy shifts. Historically, when the Fed acknowledges inflation is more persistent than expected, gold tends to benefit. When they suggest inflation is under control, gold often faces headwinds. Category 2. Employment language. The Fed has a dual mandate: price stability and maximum employment. How they describe the labor market signals their policy flexibility. A strong labor market gives them room to fight inflation aggressively. A cooling or softening labor market limits that flexibility. When the Fed begins expressing concern about employment weakness, they're telegraphing potential rate cuts ahead. Rate cuts historically benefit precious metals. Category 3. Balance sheet language. The Fed's balance sheet, their holdings of treasury bonds and mortgage-backed securities, represents printed money in the system. How they describe their balance sheet plans signals whether liquidity will expand or contract. Balance sheet expansion has historically correlated with precious metals strength. Contraction has created headwinds. Category 4. Forward guidance language. This is the most important category. The Fed tells markets what they expect to do in the future. The words they use to describe that expectation signal how committed they are. Words like likely signal moderate confidence. Words like expect signal higher confidence. Phrases like prepared to adjust signal flexibility and potential policy changes ahead. Now here's what most people miss. The Fed rarely changes direction suddenly. They prepare markets gradually through language shifts. First the language changes, then, months later, the policy changes. If you wait for the policy change, you're late. If you recognize the language change, you're early. This framework has worked for decades, and it just flashed a significant signal. Let me prove it by showing you historical examples. Example 1. The 2006-2007 language shift. In early 2006, the Federal Reserve was aggressively raising interest rates. Their statements emphasized inflation concerns. Gold was trading around $550. Most investors weren't paying attention to Fed language. They were watching price action. But starting in August 2006, subtle shifts appeared in Fed communications. References to housing market concerns emerged. Language about economic growth became less confident. The phrase, "some tentative signs of cooling," appeared where previously language had been uniformly positive. These weren't dramatic changes. Most media ignored them, but Fed watchers noticed. By December 2006, the language had shifted further. Concerns about economic growth were more prominent. Inflation language became less urgent. The seeds of policy shift were being planted. What happened to gold during this period? From August 2006, when the language shift began, gold rose from $575 to over $730 by April 2007, a 27% gain while most investors were focused elsewhere. Then in September 2007, the Fed cut rates for the first time in years. The policy shift that the language had been telegraphing finally arrived. Gold exploded higher. By March 2008, it had touched $1,000 for the first time in history. Those who recognized the language shift in 2006 positioned early. Those who waited for the policy shift were buying at much higher prices. The language shift preceded the gold move by months. It always does. Example 2. The 2011-2012 language shift. By late 2011, gold had hit $1,121. Silver had touched $50. The precious metals bull market seemed unstoppable, but Fed language was shifting. In their September 2011 statement, a new phrase appeared: significant downside risks to the economic outlook. This seemed bearish for the economy, which should have been bullish for gold. But there was another shift happening simultaneously. The Fed began discussing Operation Twist and targeted interventions rather than broad quantitative easing. The language around balance sheet expansion became more measured. By January 2012, forward guidance language included discussions of their inflation target and when rate hikes might begin. This was the first hint that the emergency accommodation era might eventually end. What happened? Gold peaked and began a multi-year decline, from $1,921 in September 2011 to $1,050 by December 2015, a 45% collapse. The language shift signaled reduced accommodation ahead. The gold market didn't recognize it immediately, but the signal was there. Those who understood Fed communication could see headwinds developing. Those who only watched price were caught in a devastating downturn. Example 3. The 2018-2019 language pivot. In late 2018, the Fed was raising rates and reducing their balance sheet. Their language was hawkish. Words like gradual rate increases appeared in every statement. The phrase further gradual increases seemed to promise more tightening ahead. Gold was languishing. It hit $1,160 in August 2018. Sentiment was terrible. But then, starting in November 2018, subtle shifts emerged. The word some appeared before further gradual increases. One word, some, hardly noticeable. By December 2018, the language shifted more noticeably. References to monitoring global developments appeared. Confidence about the rate path became less absolute. The stock market crashed 20% in December 2018. Most people attributed gold's subsequent rally to that crash. But Fed language had been signaling the shift before the crash occurred. By January 2019, Fed Chair Powell used the word patient to describe their approach. This represented a complete pivot from the hiking language of just months before. What happened to gold? From the August 2018 low of $1,160, gold rallied to $1,150 by August 2019, a 33% gain in 12 months. By 2020, it exceeded $2,000. The language shift preceded and predicted the gold rally. The pattern repeated. Example 4. The 2020 Emergency Language March, 2020. COVID-19 panic. The Fed responded with the most aggressive language in their history. Unlimited, quantitative easing, whatever it takes type statements. References to purchasing not just treasuries but corporate bonds for the first time. Language of unprecedented emergency accommodation. This wasn't subtle. but it was still language. The policy followed, but the language came first. Gold had crashed during the liquidity panic to $1,450. The Fed's language was the clearest bullish signal imaginable for precious metals. What happened? From March 2020 lows, gold hit $2,075 by August, new all-time highs in 5 months. The language had told you exactly what to expect if you were listening. Silver more than doubled from its panic low. The pattern continued. Language shift. Then price move, every single time. Now let me show you what the Fed just signaled and why few people noticed. In recent Fed communications, several significant language shifts have appeared. Shift 1. Inflation characterization. The Fed's description of inflation has evolved. Where previous statements emphasized elevated inflation with aggressive response necessary, recent language has acknowledged progress while noting work remaining. The subtle shift from urgent inflation-fighting language to measured progress acknowledgement language historically precedes rate cut cycles. It's not a declaration of victory, it's preparation for policy flexibility. Shift 2. Labor market concerns. This is where few people are paying attention. Recent Fed communications have included new language about labor market conditions. References to better balance between supply and demand have appeared. Acknowledgements that the labor market has cooled have emerged. This matters enormously. When the Fed begins expressing concern about labor market weakness rather than strength, they're telegraphing that their next policy move is more likely to be accommodation rather than restriction. Rate cuts and accommodation have historically benefited precious metals significantly. Shift 3. Balance sheet trajectory. The Fed has been reducing their balance sheet through quantitative tightening, letting bonds mature without reinvesting the proceeds, draining liquidity from the system. Recent language has introduced discussions about the appropriate pace of balance sheet reduction. References to slowing the pace of reduction have appeared. This suggests the tightening phase is maturing. When balance sheet reduction slows or stops, liquidity conditions improve. Improved liquidity conditions have historically supported precious metals prices. Shift 4. Forward guidance flexibility. This is the key shift that few noticed. The Fed's forward guidance has moved from relatively specific expectations about policy paths to more flexible language emphasizing data dependence and willingness to adjust. Phrases about being prepared to adjust the stance of monetary policy as appropriate signal openness to change. This is the language that precedes pivots. Compare this to hawkish periods when language emphasized commitment to the current path, regardless of short-term data. The current language is pivot preparation language, the same type of language that preceded the 2019 pivot, the same type that preceded 2007. What does this suggest for gold and silver? Based on historical precedent, this language configuration has preceded favorable conditions for precious metals, not guaranteed outcomes, probability-based expectations informed by pattern recognition. The Fed is preparing markets for eventual accommodation. They're not there yet, but the language is building the foundation. Those who recognize this pattern early can position accordingly. Those who wait for the actual policy announcement will be responding to news that was already priced in. The signal is there. It's in the language. It's in the historical pattern. Few are paying attention. Now you are. Let me address the obvious objections. You're reading too much into word choices. The Fed just uses different words sometimes. Incorrect. The Federal Reserve employs teams of communication specialists specifically to craft language. Every word choice is debated. Former Fed officials have written extensively about how deliberate this process is. When language changes, it changes for a reason. The historical record supports this conclusively. The Fed's language doesn't always lead to the expected policy. True. Sometimes circumstances change and the Fed adjusts. But the language signals intention and direction. Even when final policy differs, the language shift usually reflects legitimate consideration of that direction. And for precious metals, the language shift itself moves markets, regardless of whether final policy matches exactly. Markets have already priced in Fed expectations. There's no edge in watching language. Markets price in expectations, gradually. When language shifts early, before expectations become consensus, there is advantage. By the time everyone sees the policy coming, the move has already happened. The edge is in seeing the language shift before it becomes consensus narrative. That's the window of opportunity. Gold hasn't responded to recent Fed language shifts. The correlation is broken. Historical patterns don't work on precise timelines. There are leading periods and lagging periods. Other factors can temporarily override the Fed signal. But over medium-term horizons, the correlation between Fed accommodation and precious metals has been remarkably consistent. Temporary disconnections have represented opportunities, not pattern failures. Approximate runtime, 1815, 1915. So what do you actually do with this information? First, learn to read Fed statements yourself. Every FOMC meeting produces a statement. Compare it word by word to the previous statement. Note changes. The Fed's website provides all historical statements for comparison. Second, follow Fed speeches and testimonies. Fed officials give speeches that often contain language hints before official statements. These can provide early signals of shifting sentiment. Third, track the 4 language categories: inflation characterization, employment concerns, balance sheet plans, forward guidance flexibility. Note shifts in each category over time. When multiple categories shift simultaneously, the signal strengthens. Fourth, correlate language shifts with market response historically. Build your own understanding of how long after language shifts price responses typically occur. This varies but falls within recognizable ranges. Fifth, position for probability, not certainty. Fed language suggests direction and probability. It doesn't guarantee outcomes. Size positions for the possibility of being wrong while maintaining exposure to being right. Sixth, be patient. Language shifts precede price moves by months sometimes. If you're early, you may experience volatility before the expected move materializes. Patience is required. Seventh, combine with other signals. Fed language is one input. Combine it with COT positioning data, central bank purchasing, physical demand, and other signals we've discussed in previous videos for a complete picture. This is the silent economy. The Federal Reserve speaks in code. They always have. And right now, that code is signaling something significant. The language shifts I've shown you have historically preceded major moves in precious metals. The current configuration of language changes resembles previous periods that were followed by favorable conditions for gold and silver. This isn't certainty. This is pattern recognition applied to current conditions. It's seeing what most investors miss because they're watching price instead of structure. Most people will wait for the headline. They'll wait for the announcement. They'll wait until the move has already happened and then wonder how they missed it. You now have the framework to see it earlier. If this analysis gave you insight you didn't have before, subscribe and hit the notification bell. Next week, we're decoding exactly how central bank gold purchases are accelerating, which countries are buying most aggressively, and what their accumulation signals about the future of the global monetary system. Drop a comment below. Tell me what Fed language you're watching most closely. Do you see the same patterns? I read every comment. Markets reward those who see signals others miss, who study structure and language rather than just price, who position before announcements rather than after. That's the advantage. Thanks for watching. This is the Silent Economy, and we'll see you in the next one.